Good afternoon, FAC2602 students. Welcome to another lesson as part of our exam preparation for the examination that will take place on the 24th of October 2022. So in the previous few lessons we have worked through the first semester's examination. So we have finished that paper in full. You will recall that we didn't do question 4 because question 4 is a theory-based question that addresses the integrated reporting framework, which was dealt with in Learning Unit 11. So please do not disregard that learning unit because it still forms part of the FAC2602 syllabus. Alright, so just make sure that you go through Learning Unit 11 before the examination on the 24th. Alright, now as I've indicated on the FAC2602 Telegram group, during the course of this week, we will be working through 2 exam papers, that being the January 2022 supplementary examination, and then we will work through last year's examination that took place during October 2021. Okay, but for this week we are only doing the January 2022 as well as last year's examination, and then next week, which is the last week of exam preparation, we will be working through firstly the June-July 2021 examination, and we will conclude our exam preparation by working through a final paper which will be the September 2022 examination, that being the one that was written by the FI concession students. So those final year students who had less than 5 modules or only had 1 module to complete in order to graduate. Alright, now question 1 in this exam paper addresses the pro forma consolidation journal entries. Now I have also received a question on the Telegram group. I think it was Leandri who asked me this question, and she asked me whether these entries, among others right here, will always be required, okay, even when you are doing consolidated financial statements. Alright, the short answer is no. As I've indicated in lesson 1, you only do the pro forma consolidation journal entries if these are specifically requested in the required section. Alright, but if the required section only requires you to draft the consolidated financial statements, you do not need to show the pro forma consolidation journal entries. So please do not waste your time on drafting these entries if they are not required, because even though these entries may be correct, you will not earn any marks for them. Alright. However, the journal entries should be used as guidance, okay, especially if you are unsure whether or not to subtract or add a certain amount. Okay, then you quickly do the pro forma consolidation journal entry. For example, where we eliminate the unrealized profit in closing inventory, we know that we are supposed to debit cost of sales or increase cost of sales for the company who made the unrealized profit, and we need to create an inventory for the company who purchased the inventory Intergroup. Alright, so that is the normal journal entry. So we know that in the consolidated statement of profit or loss and other comprehensive income, since we are debiting cost of sales, we are increasing the cost of sales for the group. So therefore the unrealized profit in closing inventory would be added to cost of sales in the consolidated statement of profit or loss and other comprehensive income if you are eliminating the unrealized profit in closing inventory. Okay, that is just an example. So what I'm trying to say here is that do not do the pro forma consolidation journal entries if they are not required, but you can, just to make sure that you are on the right track in drafting your financial statements. Alright, but for the purposes of this question, only these 4 journal entries are required. Okay, so we do not need to eliminate, for example, the owner's equity at acquisition. Alright, that will not be required in this question, even though that is still an official pro forma consolidation journal entry. You will not earn any marks for that entry if it was not required. Okay, so we are required to draft the following pro forma consolidation journal entries of the DEC Limited Group for the year ended 31 December 2021 after taking the above mentioned information into account. And we have to pay attention to our please note section as well. As always, with your pro forma consolidation journal entries, you need to indicate to which company each account refers. And in this question, journal narrations are not required. So please do not waste your time on describing your journal entries. Okay, that's what it means if they say that journal narrations are not required. It means that you do not need to describe your journal entries. Okay, as always, we need to show all our calculations, no matter how simple those calculations are. Round off all amounts to the nearest rand and ignore the taxation effect on unrealized profits and or losses, capital gains tax and dividends withholding tax, as this will be addressed in your third year accounting modules. Alright. Okay, now normally with a question that requires certain pro forma consolidation journal entries, the entries requested will normally be given in the same order as the information itself, meaning that number A requires us to record the non-controlling interest share in revaluation surplus for the current year. So most likely we are going to find that information in additional information point 1, and then we move over to point 2 and point 3 and so on. Okay, so as you can see, it will follow in a certain sequence. Alright. Okay, so let's start with our required section. Okay, now before we start with the actual question, we need to indicate our current financial year, as with any other question. So according to our required section, our financial year ends on the 31st of December 2021. So it will start on the 1st of January 2021. And, let me just correct that. So it starts on the 1st of January 2021 and it ends on the 31st of December 2021. Okay, this might seem simple, okay, unnecessary, okay, but it is in fact necessary, because if there was an intergroup transaction that occurred in a previous year, okay, for example on the 25th of December 2021, or 2020 rather, okay, if a transaction occurred on that date, we need to keep in mind that we will use the retained earnings account of the relevant company. Okay, that is just a simple example, which is why we indicate our current financial year. Alright, and from the name of the group, we will also be able to establish our parent. So DEC Limited will be our parent, and the other company that they refer to in the information will be our subsidiary. Alright, for this question, we do not need to draft the analysis of owner's equity. Alright, that would not be necessary. So DEC Limited is the parent, and I think it was Cards Limited. Yes, Cards Limited will be the subsidiary. Okay, so let's start with number A, alright, which requires us to record the non-controlling interests in the revaluation surplus for the current year. In other words, we need to determine the revaluation surplus for the current year and then allocate the portion attributable to non-controlling interests. Alright, now if you go to additional information point 1, it says the following. Okay, remember this is just background information, we do not really need that. But let's go to additional information point 1, which says the following. DEC Limited acquired 80% interest in the ordinary shares of Cards Limited on the 1st of July 2020. Okay, what is the significance of this? So the parent possesses 80% of the ordinary shares in Cards Limited, right, or issued by Cards Limited. So if the parent's share in the ordinary shares of the subsidiary is 80%, then it means that your non-controlling interests, or NCI, would take up the remaining 20%. Okay, and we need the NCI's percentage in order to allocate the amount of revaluation surplus correctly. Alright, so the first note you can make for number A will be that your NCI for ordinary shares is 20%. Okay, we do not deal with preference share capital in question 1. Alright, how did we get the 20%? Because DEC Limited has an 80% interest, so your non-controlling interest would take up the remaining 20. Okay, the group was formed in the previous financial year, okay, on the 1st of July 2020. Assume that each ordinary share carries 1 vote and that voting rights alone determine control, okay, as will be the case in every question in this module. So So in other words, we only determine the number of ordinary shares owned by the parent to determine whether the parent actually has control or not. Okay, and we know that for the purposes of this module, the parent must possess or own 50% or more, okay, more than 50% rather. Okay, the parent must be a majority shareholder, so therefore the parent must own more than 50% of the issued ordinary shares of the subsidiary in order to have control, okay, in order for the group to be actually formed. Okay, so that is just theory that you need to take note of. The carrying amounts of all the assets and liabilities of Cards Limited were deemed equal to their fair values at acquisition. Right. Now we get to the revaluation surplus part, which says that the land of Cards Limited, so in other words, the land of the subsidiary, had a fair value of 1,500,500 Rand at the acquisition date. So the value of this particular land on the 1st of July 2020 was 1,500,500 Rand. Alright. Now Cards Limited assessed the fair value of the land in the current year to 2,050,000 Rand. This was the only revaluation in the current reporting period, and the revaluation was recorded correctly in the accounting records of Cards Limited. Cards Limited applies the revaluation model to land. Okay, so we will use these two amounts right here in order to calculate the current year's revaluation. Okay, the revaluation occurred within the current financial year. All right. So the current year's revaluation surplus is calculated, or current year's revaluation surplus would be calculated by taking the amount or the adjusted fair value of that particular land, which is 2,050,000. Damn it, let's just go back to Word. Thank you very much. So 2,050,000, and then we will subtract the original value of that land at the date of acquisition, which was 1,500,500. Okay, the difference between those two amounts will give us the total revaluation surplus for the year for Cards Limited. And if you calculate this correctly, you should arrive at an amount of 549,500. Okay, so this was the current year's revaluation surplus in total for the subsidiary. Okay, what we need to do is that we need to take this amount, okay, and we need to remove the portion that is attributable to your non-controlling interests. Okay, so in other words, when Cards Limited made or accounted for the revaluation, okay, so when they recorded the current year's revaluation surplus, they would have debited land by 549,500, and they would have credited revaluation surplus by the same amount. Okay, that is the recording of the revaluation surplus for the current year. Okay, but now we need to remove the portion that is attributable to your non-controlling interests, and we calculate that amount by taking the NCI share, which is 20%, out of that total amount. So NCI share would be equal to 20%. Okay, we have already determined that, and we need to multiply that by the current year's revaluation surplus amount of 549,500, and your answer should be 109,900. Alright, now the journal entry that we will make in order to account for the NCI share in the current year's revaluation surplus will be that we need to debit revaluation surplus because we are removing the portion of RVS that is attributable to non-controlling interests. Okay, and since we deal with non-controlling interests, it will not really be necessary to indicate that this revaluation surplus pertains to the subsidiary. Okay, alright, so we debit revaluation surplus by 109,900, and we will credit or increase non-controlling interests as shown in our statement of financial position or the consolidated statement of financial position by the same amount. And as stated in our required section, we are not required to give journal narrations. All right. Okay, let's move to question B. Okay, or journal entry number B. Okay, so we have determined the NCI share is 20%, and we have calculated the current year's revaluation surplus correctly, and we have removed that portion that is attributable to NCI, and we have shown the journal entry right here. Okay, let's go to number B. So just 2.5 marks for that specific journal entry. Number B says that we need to eliminate the intergroup profit or unrealized profit and the depreciation associated with the sale of the machine. Okay, sometimes they'll just indicate, okay, just eliminate the unrealized profit on the intergroup sale without eliminating the depreciation. Okay, in this particular journal entry, we need to eliminate both. So we will first calculate the unrealized profit or loss. Okay, both are possible, and we will eliminate that amount. And then we need to calculate the unrealized depreciation and also remove that amount. Okay, for 8.5 marks. So that will be found in additional information point 2. Okay, which says the following. Now, on the 1st of August 2020, okay, take note that this is in a previous financial period. Okay, more specifically the previous financial year. So therefore, we will most likely make use of retained earnings. All right, so just keep that in mind. So on the 1st of August 2020, Cards Limited sold a printer to DEC Limited for a cash consideration of 150,000. So the printer was sold for 150,000. Okay. On the date of sale, so on the 1st of August 2020, the printer had a cost of 200,000 Rand and a carrying amount of 105,000. It is the group's policy to provide for depreciation on machinery at 20% per annum using the straight line method. Okay, so as I've indicated, we will first eliminate the unrealized profit or loss. Okay, in this case it would be a profit that was made. Okay, how do we calculate the profit that was made? Okay, so what we will do is that we will take the proceeds on the sale of that particular printer, which was 150,000. Okay, so it was 150,000 was the selling value of that specific printer. Okay, that was the amount received by DEC Limited because DEC Limited purchased that particular printer. So Cards Limited received 150,000 for that machine on the intergroup sale, and on that date the carrying amount was 105,000. Remember, for the purposes of calculating the profit or the loss that was made on an intergroup sale of property, plant and equipment, we need to consider the carrying amount on the day of sale, not the actual cost of that specific asset. Alright, so in this case we will just ignore the printer's cost price of 200,000, and we will also use the unrealized profit or loss in order to calculate the unrealized depreciation. So you do not need the cost in this particular journal entry. Alright, they have just put it there in order to test that you have chosen the they have just put it there in order for you to choose the right amount, okay, in order to calculate the unrealized profit. Because if you use the cost instead of the carrying amount, you would have arrived at a loss of 50,000, okay, which is incorrect. Okay, so therefore we only consider the carrying amount on the day of sale in order to calculate the unrealized profit or loss. So in this case it was a profit that was made due to the fact that the proceeds exceeded the carrying amount. So the proceeds less the carrying value of the printer on the date of sale, which was the 1st of August 2020, and you will then arrive at an amount of 45,000. Okay, so 45,000 is the amount of the unrealized profit. We know that a profit was made because Cards Limited received more for the printer than its carrying value. Alright, if it was the other way around, then a loss would have been made. Okay, and we also need to keep in mind that DEC Limited would have included this profit of 45,000 in the carrying value of its property, plant and equipment, meaning that the cost of that specific printer in DEC Limited's records will be 150,000. Okay, of which 45,000 is a profit that was made on the Intergroup sale, which we need to eliminate for consolidation purposes. So in order to eliminate the unrealized profit on the Intergroup sale of the printer, we will first need to debit retained earnings for Cards Limited. Okay, why do we use retained earnings and not profit on sale of machinery? It is because of the fact that the profit was made in a previous financial period. Okay, so therefore we make use of retained earnings and not the specific income item of profit on sale of machinery. Okay, the amount was 45,000, and then we would have credited either property, plant and equipment, so PPE, or you could have credited machinery. Okay, they make use of machinery in this question, okay, because they stated that they provide for depreciation on machinery at 20% per annum using the straight line method. So you can either credit property, plant and equipment, or you can credit machinery. Okay, both will be correct, but please do not put both there. All right, and we know that DEC Limited purchased that specific printer, and we will credit that by the same amount of 45,000. Okay, so in other words, what we are doing here is that we are reducing the carrying value of the group's property, plant and equipment, because 45,000 was an unrealized profit, and we are decreasing the actual profit made by the subsidiary in a previous period. Okay, because that was Intergroup, and we know that the group itself cannot make a profit by concluding a transaction with itself. Okay, if that makes sense. Okay, but we are not done with the journal entry yet. We still need to calculate the unrealized depreciation that we need to eliminate for consolidation purposes, since it is a depreciable asset that was sold Intergroup. Okay, we first eliminated the unrealized profit by debiting retained earnings of Cards Limited and crediting machinery or property, plant and equipment for DEC Limited. Alright, let's move over to the unrealized depreciation. So because we are using the straight line method, we do not need to split the respective periods. Okay, so in other words, we can combine the two periods in order to calculate the unrealized depreciation, because otherwise, if it was a reducing balance method, you would have calculated the unrealized depreciation for the previous period, okay, and then you would have taken that amount, subtracted it from the unrealized profit in order to calculate this year's unrealized depreciation. Okay, I think I covered a similar example in, was it question 1? I think it was question 1 in the May-June 2022 examination, okay, where they used the reducing balance method. So please have a look at that lesson again. Question 1 for the May-June 2022 examination, okay, where the reducing balance method was used instead of the straight line method. In this case, we use the straight line method. So the unrealized depreciation that we need to eliminate, okay, will be from the 1st of August 2020, which is the date of sale, and all the way to the 31st of December 2021, which is the end of this financial year, okay, the end of the current financial year. So it will be calculated by taking the unrealized profit of 45,000. We will multiply that by 20%, and the period between the 1st of August 2020 and the 31st of December 2021 would be a total of 17 months. Okay, 5 months in the previous year and 12 months for the current year, logically. Alright, and if you calculate this correctly, you should arrive at an amount of 12,750. So this is the total unrealized depreciation that needs to be eliminated for consolidation purposes. However, we still need to allocate the amount between, or we need to apportion the amount between the previous year as well as the current year. Okay, because the previous year's unrealized depreciation would be eliminated against retained earnings, and the current year's depreciation, unrealized depreciation rather, would be eliminated against the depreciation expense. Okay, so that's very important. So the previous period or previous year, okay, would be 45,000 times 20% times 5 over 12. Okay, it will be from the 1st of August 2020 up until the 31st of December 2020, the end of the previous financial year. And then you should arrive at an amount of 3,750. Okay, and then the current year's depreciation would be the remaining amount. Okay, 12,750 less 3,750, which is 9,000. Okay, you could have also calculated this by taking the unrealized profit of 45,000 and multiply it by 20% for 12 months. Okay, so there are two ways in which you could have calculated the current year's unrealized depreciation. Okay, so this is the total that we need to eliminate, of which 3,750 is in respect of the previous year and 9,000 pertains to the current year. Okay, and since we know that an unrealized profit was made, we know that the company who purchased the printer, which is in this case DEC Limited provides for too much depreciation in its own financial records. Okay, because of the profit that was made on the intergroup sale of the machinery or the printer, and therefore we need to reduce the total depreciation that they have provided for. Okay, so your journal entry will be that we need to debit accumulated depreciation for DEC Limited. Okay, because that is the company that purchased the printer Intergroup. They are the that is the company that provides for too much depreciation because of the unrealized profit that was made. And the total depreciation that we have eliminated is 12,750, of which 3,750 is in respect of the previous period. So therefore we will credit retained earnings of Cards Limited because they made the profit, 3,750, and then we will also credit depreciation of the company that made the original profit, which is in this case Cards Limited. Okay, and 9,000. Alright, so that is the journal entry in order to eliminate the unrealized depreciation associated with the intergroup sale of the printer. Okay, so the effect of this will be that firstly, the elimination of the unrealized profit will decrease the carrying value of property, plant and equipment for the group. So in your consolidated statement of financial position, you would have subtracted this amount in the property, plant and equipment line under non-current assets. And for the unrealized depreciation that you have eliminated, because we are decreasing accumulated depreciation, we are actually increasing the carrying value of PPE. So therefore you would have added this amount in the PPE line in your consolidated statement of financial position. Okay, so the unrealized profit would be subtracted and total unrealized depreciation would have been added to the property, plant and equipment in your consolidated statement of financial position. Okay, logically, if a loss was made, then the entries would just be the exact opposite. Okay, I think there was a similar example in one of the exercise questions in the study guide. Okay, focus on learning units 7 to 9. Alright, so just keep that in mind also. It doesn't have to be a profit that was made. Okay, it can also be a loss that was made on the intergroup sale. The procedure still remains the same, but your journal entries would just be the other way around. Okay, so for example, if we have eliminated an unrealized loss, okay, in this question, so let's say the 45,000 was an unrealized loss, then we would have debited machinery for DEC Limited, and we would have credited retained earnings for Cards Limited. Okay, so these two would just be swapped, and the same applies to the unrealized depreciation, because in the case where an unrealized loss was made, the company that purchased the machinery Intergroup will provide for too little depreciation. Okay, so therefore we need to increase the total depreciation that they have to provide for. Okay, so what I'm trying to say here is that the elimination of an unrealized profit and the elimination of an unrealized loss would just require the exact opposite journal entries. Okay, that's what I'm trying to say. Okay, but 98% of the cases will be where an unrealized profit was made. Okay, but a loss is possible. So please take note of that. Alright, so we are done with number B. We have eliminated the unrealized profit and we have eliminated the unrealized depreciation. Okay, that will give you a total of 8.5 marks. Please do not forget to indicate to which company each account refers. Okay, you get marks for that, as you should have seen in your feedback for assignment 2. Alright, then we get to number C, which requires us to eliminate the unrealized profit in opening inventory. Okay, 3.5 marks. Now, point 3 says the following. Now, since acquisition, which was the 1st of July 2020, the previous financial year, Cards Limited purchased inventory from DEC Limited at a consistent markup on cost plus 20%. So 20% is the unrealized profit made on the Intergroup sale of inventory. Now, inventory amounting to 580,000 Rand remained on hand in Cards Limited's records at the end of the previous financial year. So the 580,000 is the closing inventory of the previous year. So this was the balance of inventory on the 31st of December 2020 in Cards Limited's records. Okay, and we are concerned with Cards Limited's inventory because that is the company that purchased the inventory Intergroup. Okay, and of this 580,000 Rand closing inventory of the previous year, so that will become the opening inventory for this year. Okay, 30,000 or 30% rather of that inventory was purchased from DEC Limited. So in other words, 30% of the 580,000 was purchased into Intergroup, and that will be the portion that includes the unrealized profit of 20% that we need to eliminate for consolidation purposes. And then DEC Limited sold inventory amounting to 1.5 million Rand to Cards Limited during the current year. Okay, once again, it is important to read your required section very carefully. They do not require us to eliminate Intergroup sales. Okay, so therefore we will not be concerned with the 1.5 million because that is the amount of Intergroup sales that we know we should eliminate for consolidation purposes, but the journal entry is not required in this question. Okay, we only need to remove or eliminate the unrealized profit in opening inventory. Okay, that is the only thing that we need to do for the inventory transaction. Okay, so let's first calculate the unrealized profit made. So for number C, your procedure will be as follows. The unrealized profit in opening inventory would be calculated by taking the value of 580,000, which was the value of closing inventory for Cards Limited at the end of the previous financial year. So that will be this year's opening inventory. Okay, we multiply by 30% because 30% of this inventory was purchased Intergroup. So only the 30% will include the unrealized profit that we need to eliminate. And then we eliminate the unrealized profit by multiplying it by 20 over 120. We use 20 because the unrealized profit made is 20% on cost. Okay, and we use 120 because the value of inventory right here already includes the unrealized profit. Okay, that is why we use 120 instead of 100. Okay, and you should arrive at an amount of 29,000. Let me just confirm. It is indeed 29,000. Okay, now in order to eliminate the unrealized profit in the opening inventory, we first need to determine which company made the profit on the Intergroup sale of inventory. In this case, it was DEC Limited. Okay, DEC Limited sold the inventory Intergroup to Cards Limited. Okay, so in order to eliminate the unrealized profit in opening inventory, we will debit retained earnings for DEC Limited by 29,000, and we will credit cost of sales for DEC Limited as well. Okay, because keep in mind that during the previous year, okay, So at the end of the previous financial year, in order to eliminate the unrealized profit in closing inventory, because remember we are talking the previous financial year now, you would have debited cost of sales for DEC Limited by 29,000, and you would have credited inventory for Cards Limited by 29,000. That is the elimination of unrealized profit in closing inventory for the previous financial year. Okay, but we now need to reverse that entry by decreasing cost of sales for this year. Okay, because we increased cost of sales for the previous year, so for this year we need to increase cost of sales. We need to decrease cost of sales again by debiting retained earnings and crediting cost of sales for the company that made the unrealized profit on that intergroup sale of inventory. Okay, so let me just show it very clearly. So this portion right here would be the entry in respect of the previous year. So cost of sales, DEC Limited, and inventory for Cards Limited. Okay, and the amount that we will use is 29,000. Okay, so this entry right here is in respect of the previous financial year. Okay, so on the 31st of December 2020, you would have made the following pro forma consolidation journal entry, which is the elimination of unrealized profit in closing inventory. Okay, so what we have done here is that we have increased the cost of sales account for DEC Limited because they made the profit, and since it is an unrealized profit, we need to decrease the profit that the group made, and we can only do that by increasing the cost of sales account. So this entry causes the profit for the group to decrease because we increase cost of sales. Okay, now for this year, because the closing inventory right here, or used in order to calculate the unrealized profit of 29,000, will become the opening inventory for this year. And for this year, we need to reverse that entry by debiting retained earnings and crediting cost of sales, both for the company that made the unrealized profit. Okay, same amount, 29,000. And for this year, since we are decreasing cost of sales for the group, we are actually increasing the profit made by the group. Okay, I hope that explanation is very clear. Alright, so in conclusion, this will be your journal entry in order to eliminate the unrealized profit in opening inventory. Okay, 29,000. We have shown the calculation right here. And then the final journal entry that we are required to draft would be number D, which is the elimination of the intergroup dividend as well as the recording of the non-controlling interest share in the dividend declared. Okay, for 2.5 marks. So according to additional information point 4, the total dividend declared by the subsidiary, okay, Cards Limited, in the current year amounted to 75,000. Okay, so dividends declared by Cards Limited is 75,000. Okay, of which 15,000 was allocated to non-controlling interests and 60,000 was allocated to the parent, okay, DEC Limited. This dividend has not been paid yet, okay, but it has already been declared. Okay, now I need you to pay attention to the following entries that I'm about to make. Now, in the absence of any further information, we will assume that both companies accounted for the dividend declared. Okay, so in other words, for number D, and this is just for explanation purposes, the entry that was made in Cards Limited's records would be the following. So they have debited dividends declared of 75,000, and they would have credited dividends payable because those dividends have not been paid yet, okay, by the same amount, 75,000. So this is the entry that was made in Cards Limited's records, and in the parent's own records, okay, in DEC Limited's own records, they would have made the following entry. Okay, they would have accounted for dividend income or dividends receivable amounting to 60,000. Okay, and they would have credited dividend income with the same amount. So these two entries right here would be in respect of the two companies in their own capacity, meaning that these two entries were not made in the group's journal, or were not part of the group's journal entries. Okay, these are the journal entries that were made in each company's records, okay, respectively. All right, what we now need to do is that we have to eliminate the intergroup dividend of 60,000 because that was paid to the parent, and we need to allocate the portion of the total dividend declared by the subsidiary to non-controlling interests. And for this one, we will use dividends declared and dividend income. All right. So in order to elimination of intergroup profit, or intergroup dividend rather, plus the NCI's dividend. Okay. All right. Let me just move this over to the next page, or to the next page. So the journal entry that you will make will be that we will debit dividend income, okay, and this was accounted for by DEC Limited by 60,000. We would also debit non-controlling interests. So the amount of 15,000 will be subtracted in the consolidated statement of changes in equity, okay, which is why we debit non-controlling interests, and we will credit dividends declared by Cards Limited. Okay, this is the correct journal entry that we need to make. Okay, in order to eliminate the intergroup dividend and record a non-controlling interest share in the current year's dividend. Okay, we will use the dividend income of the parent as well as dividends declared by the subsidiary. Okay, 75,000. Okay, but there is another pro forma consolidation journal entry that we need to make. Okay, and that is the elimination of common items. Now the common item will be the dividends receivable, okay, of 60,000, and we will need to, let me just correct this, that should be dividends payable. Okay, the dividends have not been paid. Okay, the dividends are still payable, and we have a common item of 60,000, and your common items pertain to the consolidated statement of financial position. Okay, so we need to eliminate the dividends receivable by the parent because that is an intergroup item or a common item that we also need to eliminate. So we will debit dividends payable by Cards Limited with 60,000, and we will credit dividends receivable by DEC Limited by the same amount. So in effect, the total amount of dividends payable by the group will be 15,000. Okay, so in your consolidated statement of financial position, you will show under current liabilities dividends payable 15,000. Okay, because that is the amount that must be paid to non-controlling interest, and that is the only portion that is not an intergroup dividend. All right. And since the dividends have not been paid, they are still payable. So this, or these two journal entries right here can be eliminated in two parts. Firstly, we eliminate the intergroup dividends as well as record the non-controlling interest share in the current year's dividend by conducting this journal entry right here. This was the one that was required. Okay, so in your consolidated statement of profit or loss and other comprehensive income, you will subtract 60,000 Rand from other income. Okay, dividend income is normally part of other income, so therefore this amount would be subtracted as we normally do, and the amount for non-controlling interests, which is 15,000, will be subtracted in the consolidated statement of changes in equity. Okay, as we also normally do. Okay, And for the elimination of common items, so for the considered statement of financial position, you will debit dividends payable to the parent, because that is an intergroup dividend that must be eliminated, and you will credit dividends receivable by the parent, which is 60,000, because that is a common item that we eliminate. So in effect, the only dividends payable by the group itself will be 15,000, and that will be to non-controlling interests. Alright, I have also summed this up, or summarized it rather, in the document of suggested solutions that I will also share once all the lessons for this examination paper have been uploaded on Google Classroom. Okay, that concludes question 1 for the January 2022 supplementary examination. In the next lesson, we will start with question 2. I will once again draft the entire set of consolidated financial statements to ensure thorough exam preparation. And I will again divide those, or that lesson rather, in 2 parts. So we are going to do question 2 part 1 as well as question 2 part 2. And then the final lesson on this examination paper will be question 3, which addresses the statement of cash flows for a single company. Okay, I will see you in the next lesson. Have a great afternoon or evening whenever you are watching this, and thank you for the positive feedback that you guys have been giving me. I really appreciate it, and I hope that each of these lessons will help you to pass the module